In the United States, rent, insurance, and mortgage payments depend on more than income, and few cities demonstrate this shift more clearly than Miami. For decades, Miami symbolized arrival, warm weather, ocean views, no state income tax, a place where retirement felt permanent and success felt visible. But beneath the skyline, a quieter reality is forming. Housing costs are climbing faster than stability. Insurance is becoming harder to secure. Property taxes are rising alongside valuations. And for many residents, the financial math is no longer working. What was once marketed as a dream is slowly becoming a risk calculation. Why this city matters now. Across America, financial comfort is quietly eroding. Interest rates remain elevated compared to the ultra-cheap borrowing era that defined the early 2020s. Mortgages that once felt manageable now lock buyers into significantly higher monthly payments. At the same time, insurers are reassessing exposure, especially in coastal regions vulnerable to hurricanes and flooding. Some companies are increasing premiums dramatically, others are withdrawing altogether. Meanwhile, migration patterns are reshaping entire states. Remote workers once fled expensive northern cities searching for affordability. Retirees followed, drawn by tax advantages and sunshine. Investors accelerated the trend, purchasing properties before supply could catch up. For a moment, Miami appeared unstoppable. But rapid growth carries consequences. When population rises faster than infrastructure, faster than housing supply, and faster than risk models can adapt, pressure builds beneath the surface. Today, Miami is no longer just a lifestyle destination. It is becoming a case study in modern American housing stress. One rent reality when demand outruns stability. For years, Miami's rental market moved in one direction, upward. New arrivals competed for limited inventory. Landlords adjusted prices quickly, sometimes between lease cycles. What had once been considered luxury pricing gradually became standard. Middle-income earners, nurses, technicians, small business employees began spending a larger share of their paychecks simply to remain housed. The traditional financial guideline of keeping housing near one-third of income became increasingly difficult to maintain. Instead, households stretched. Savings rates declined. Emergency buffers thinned. Financial flexibility narrowed. Some residents accepted longer commutes to find relief farther inland. Others downsized, trading space for affordability. But even those adjustments offered only temporary breathing room. Because Miami's housing market is influenced not only by local wages, but also by global wealth. International buyers, high-income relocators, and investment groups often operate under different financial constraints than long-time residents. This creates a two-speed market. One tier moves comfortably. The other recalculates every renewal notice. And over time, that imbalance reshapes who the city is truly built for. To insurance and taxes, the invisible monthly shock. If rent is the visible cost of living, insurance is the silent one. Florida's exposure to severe weather has forced insurers into a defensive posture. Risk models have become stricter, premiums have climbed, deductibles have widened. For homeowners, the shift can feel sudden, a renewal letter transforming a manageable payment into a heavy obligation. But the impact does not stop with owners. Landlords facing higher insurance costs often pass those increases into rent structures. Condo associations adjust fees to maintain coverage requirements. Buyers discover that mortgage approvals increasingly depend on insurability. Even property taxes contribute to the pressure. As home values rise, so do assessments. What appears to be paper wealth can translate into real annual expenses, regardless of whether household income has kept pace. Together, mortgage, insurance, association fees, and taxes form a layered cost structure. Individually manageable, collectively transformative. The result is not always immediate displacement, but a slow tightening of financial margins. A city can feel prosperous while quietly becoming fragile. 3. Who is leaving and why it matters. Migration once defined Miami's growth. Now a quieter countermovement is emerging. Some retirees originally drawn by predictable living costs are reconsidering long-term sustainability. Fixed incomes do not adjust easily to volatile insurance markets. Certain families are relocating to smaller Florida cities or leaving the state entirely, searching for cost structures that feel less exposed. Younger professionals, meanwhile, are approaching the city with greater caution. High entry costs delay homeownership timelines and reshape career decisions. Even high earners are becoming more analytical. The question is no longer just, can this be afforded today? It is increasingly, will this remain affordable 5 years from now? When residents begin planning exit strategies instead of long-term routes, the character of a city changes. Schools see shifting enrollments. Local businesses face unpredictable demand. Communities lose continuity. The transformation is subtle but cumulative. For street-level reality beyond the skyline. From a distance, Miami still projects momentum. Construction cranes remain active, restaurants open, tourism flows. But street-level conversations reveal a different tone. Neighbors discuss renewal increases. Association meetings focus on reserves and repairs. Homebuyers study insurance clauses as carefully as floor plans. Financial decision-making has become more defensive. Instead of asking how much property might appreciate, many are asking how much volatility they can absorb. And increasingly, housing is no longer viewed purely as a lifestyle choice, but as a long-term financial exposure. This psychological shift matters because markets are influenced not only by numbers but by confidence. When confidence softens, behavior follows. Several patterns are becoming difficult to ignore. First, housing markets heavily dependent on migration can cool quickly if affordability thresholds are crossed. Second, insurance availability is becoming as critical as interest rates. A home that cannot be insured at a reasonable cost effectively narrows its buyer pool. Third, rising fixed expenses reduce economic mobility. Households with limited financial flexibility are less able to absorb shocks, whether personal or environmental. None of these forces operates dramatically on its own. But together they create structural tension. A city does not need a sudden crash to feel unstable. Sometimes pressure builds gradually until adaptability becomes the defining skill of residency. If current trajectories persist, several exposures may deepen. Insurance markets could continue recalibrating as climate models evolve. Premium unpredictability alone can alter purchasing behavior. Housing supply may expand, but construction costs and regulatory pressures limit how quickly affordability can return. Meanwhile, interest rates remain a defining variable. Even modest shifts can significantly affect monthly payments in high-price regions. The broader question is not whether Miami will remain desirable. It likely will. The question is who will comfortably sustain life here and who will find the margin too narrow. Cities rarely lose their appeal overnight. Instead, they transition, gradually shifting from accessible to selective, from aspirational to calculated, from dream to decision. Miami still offers sunlight, culture, and global energy. But beneath the brightness, the financial architecture is changing. Housing is heavier. Risk is more visible. Predictability is thinner. And for a growing number of Americans, comfort is no longer defined by geography, but by resilience against rising fixed costs. The skyline remains. The ocean remains. Yet the definition of livability is being rewritten in real time. Because sometimes a dream does not disappear. It simply becomes too expensive to hold.